If you've been wondering about the world of Forex trading and how it works, make sure you watch this video. I'm going to go through a beginner's guide to what Forex trading is, the basics of Forex trading, and how leverage works. Welcome back to the Trading Project, where I document my journey of learning to become a profitable trader in financial markets. Let's dive into the exciting world of Forex. Forex, short for foreign exchange, is the global marketplace where currencies are bought and sold against one another. Unlike traditional stock markets, Forex operates 24 hours a day for 5 days a week, only being shut on weekends as trading occurs across different time zones. This accessibility and continuous nature make it one of the most liquid and dynamic financial markets worldwide, with trillions upon trillions of dollars trading each day. This makes it the most interesting market for traders and day traders as a result. The foundation of Forex trading revolves around currency pairs. Each trade involves the exchange of one currency for another, with the pair represented in a 3-letter code and no currency being traded in isolation. A currency pair effectively shows you the relative value of one currency against another currency. When buying or selling a currency pair, you are betting that the first currency in the pair is going to go higher or lower relative to the second currency in the pair. Let's explain this with an example on the chart. So now that we've launched our chart, we can search for the Forex pair that we're looking for. I'm going to be using the Euro USD, and you can do this by going to the top left in the symbol search and typing EURUSD, which is the code, and clicking on the top one, for example. This shows us that the current price of the Euro USD is 1.0983, which effectively is telling us that for every 1 euro, we're going to get 1.0983 US dollars. You can see historically that this was trading up closer to 1.125 and has been sort of trending down. The main thing that you need to know about this is that if you buy this pair, the Euro USD, you're effectively betting that the value of the euro is going to go up relative to the USD. So the magic rule for this is that you're actually buying or selling the first quoted currency against the other one. Forex traders often use the term pips. A pip is the standard unit of measurement for change in a currency pair in the Forex market, and also the smallest incremental value change between a currency pair. This is worth 1/100th of 1 cent, and this would translate to being the 4th decimal point in the currency pair. So for example, if the Euro US dollar goes up 1 pip, we would expect this 3 to change into a 4. 1 pip on one standard lot equates to a $10 gain or loss in that specific currency pair. We're going to talk more about standard lots and contract sizes shortly. Now, Forex is done through brokers, which provide traders like ourselves with access to the market through trading platforms where we can execute our buy and sell orders. There's several brokers to choose from, and I'll go through the best different brokers in a separate video. An important aspect of Forex trading is leverage. Leverage provides you with increased exposure to a Forex pair or security with borrowed funds from that broker, which lets you take larger trading positions with smaller capital. In Forex, the standard size of one contract or lot is typically 100,000 units of that currency, and there are also mini and micro lots that are 10% and 1% of a standard lot size respectively. So, in our Euro USD example earlier, one standard contract would represent approximately $110,000. I don't know about you, but I don't have 110k sitting around for me to trade, so as a result, we can use leverage. Different brokers offer leverages which can be 1 to 10, 1 to 30, 1 to 100, and even more than 1 to 1000. Let's use the 1 to 100 example here. If you deposit $1,000 of your own money into your brokerage account with a 1 to 100 leverage, you effectively have $100,000 worth of buying power. So by taking a $1,000 trade, your position is actually exposed to $100,000 and your profit or loss fluctuates based on this amount. This can be beneficial if you're taking a winning trade, but may also mean you blow up your account even quicker. There are plenty of Forex calculators online that help you calculate your trading size, position, profit, and margin. This one, for example, you can select the instrument, so we were looking at the Euro USD. We can select one lot, and for leverage, we'll choose 1 to 50. You can enter your opening price and closing price. So I've chosen 1.098 and 1.099. This is effectively telling you that you're going to be making 10 pips on this trade, since we know that 1 pip is the 4th decimal point. Then you simply hit calculate, and it should show up showing you how much a tick is, what the pip value is, and what your overall profit will be for this trade. In this example, it's going to be 100 US dollars on a 1 standard lot with a 1 to 50 leverage. With that being said, I'll end this video here to keep it short and basic on how Forex trading and leverage work. I'm going to begin paper trading shortly, and I will do this using a leveraged Forex account whilst I get some experience in trading and figure out how things work. So stay tuned for more videos around that. If you enjoyed and found this helpful, it'd make my day if you liked, subscribed, and commented to help me grow and spread the word about my trading journey into becoming a successful trader. Thanks for watching, and see you in the next one.